If you really want to get a feel for where the US economy is headed, you could look at a million different indicators. But one of the best ways, one of the most direct, is to just see what's actually moving around the country. And that's why we're going to dig into the latest earnings report from one of America's biggest trucking companies, Old Dominion Freight Line, to see what their numbers tell us about the road ahead.
So first, a quick rundown. Old Dominion, or ODFL as you'll see it called, is an absolute giant in what's known as less-than-truckload shipping, LTL for short. Basically, it means they're experts at moving pallet-sized freight for thousands and thousands of businesses. We're talking everything from heavy machine parts to retail goods. And because they're touching so many different parts of the industrial and commercial economy, well, their performance is a fantastic real-time barometer for business activity across the entire country.
So, what's the big question here? Simple. Is the US economy finally shaking off this slowdown and getting ready to accelerate? Or are we in for some more bumps in the road? Well, Old Dominion's latest numbers give us a really fascinating and, honestly, a kind of contradictory answer. Let's start with the good news, because on the surface, ODFL's fourth quarter report for 2025 looked pretty solid. A real win, actually. They beat Wall Street's forecasts on the two numbers that investors care about most.
First up, profit. The company posted earnings per share of $1.09. Now, analysts were expecting $1.06. So, yeah, it's a small beat, but hey, a beat is a beat, and that's always a positive signal to the market.
And they didn't just beat on profit, they beat on the top line, too. Revenue came in at $1.31 billion, just squeaking past the $1.3 billion that was expected. So right out of the gate, the headline numbers, they look pretty strong. And all this points to a company that's in really good financial shape. I mean, for the whole year, they generated $1.4 billion in cash from their operations. They used over $730 million of that to buy back their own stock, and they even bumped up the dividend they pay to shareholders. These are all things a management team does when it feels really confident about its financial position. The company's CEO, Marty Freeman, he summed it up perfectly. He said their solid financial results came from their focus on revenue quality and cost discipline. So, from a purely financial point of view, things are looking good. But, you probably guessed it. Those headline numbers, they don't tell the whole story, not even close. Because when you pop the hood and look at the actual physical business of moving freight, a very, very different picture starts to emerge. And this is where we get to the bad news. This really challenging operating environment that Old Dominion and, let's be real, the entire US economy is still trying to navigate. Okay, now this slide is where the plot thickens. Look at this contrast. So despite beating what the analysts thought they'd do, ODFL's actual business activity dropped, and dropped significantly compared to the same time last year. Total revenue was down almost 6%. But look at the volume numbers. The amount of stuff they moved, the tonnage per day, fell by almost 11%. And the number of shipments per day was down almost 10%. The takeaway here is crucial. They're just moving less stuff. Period. All right. To get this next part, we need to quickly talk about a key industry metric. It's called the operating ratio, or OR. It's actually pretty simple. It's just the percentage of revenue a company has to spend on its operating costs. So the lower the number, the more efficient and profitable you are. Simple as that. And well, here's the problem. Old Dominion's operating ratio got worse. It went from 75.9% up to 76.7%. Now, that might not sound like a huge jump, but in the world of logistics, that's a meaningful hit to efficiency. It basically costs them more money to make every single dollar of revenue. So why that happen? The CEO called it a deleveraging effect. In plain English, that means when you have fewer shipments moving through your huge, expensive network of trucks and warehouses, your fixed costs, like rent and salaries, start to eat up a much bigger piece of the pie. So even with good cost control, that drop in volume made them less efficient. So, what do we have? We've got strong financials on one hand, but weakening business volumes on the other. It's a real mixed bag. So this brings us to the big finale, the outlook. What does Old Dominion see coming down the road for 2026? The official line from the company is that they are cautiously optimistic. They've been through these kinds of economic cycles plenty of times before, and they're starting to see some little signs that things might finally be turning a corner. And they have some solid reasons for this optimism. It's not just wishful thinking. The ISM Manufacturing Index, which is a major leading indicator for freight, it just turned positive. But even more important, they're seeing the average weight of each shipment start to climb back up, from around 1,450 pounds to 1,520 pounds. Now, why does that matter? Because heavier shipments usually mean more industrial goods are being moved, and that's a core driver of the entire economy.
The company's CFO, Adam Satterfield, he put it this way, saying that these positive signs have been building up over the last couple of months. So this isn't just a one-off blip on the radar. They think they might be seeing a real trend start to form. And this, for me, is where the story gets really compelling. Okay, so if the economy is about to shift into a higher gear, a trucking company has got to be ready to handle that surge in demand, right? So how is Old Dominion preparing for that? With this, a whopping 35% spare capacity in their network. Think about that. While a lot of their competitors were hunkering down, ODFL kept investing. Their entire network is built to handle over 55,000 shipments a day, but right now they're only doing a little over 40,000. That is a massive amount of room to grow without even breathing a sweat. And it's this readiness that lets CEO Marty Freeman say, with a whole lot of confidence, we are better positioned than any other carrier to capitalize on an improving economy. They've got the trucks, the terminals, the people. They are ready to go the second business picks up. So that's where things stand. You can think of Old Dominion as this powerful truck sitting at a stoplight. The engine is revving, the tank is full, and they've got a wide open lane right in front of them. They've managed to get through the slowdown, and now they're seeing those first glimmers of a green light from the broader economy. The big question left is, when is that light going to change? And the answer to that is going to tell us a lot about the road ahead for all of us.